Okay, and let's go ahead and take a look at chapter 13. I'm going to put this in hiding presenter view, and we're going to go ahead and get started. Okay, guys, once we start the class, that's the time to end conversations. Okay, so we go ahead and we take a look at current liabilities. And as I mentioned, chapter 12 is only the only chapter where we're going to be dealing with assets, essentially. The bulk of Intermediate 2 is looking at the liability side of the balance sheet. So we're going to begin that discussion here, talking about current liabilities and contingencies. When we get into chapter 14, then we'll move to longer-term liabilities, and our primary focus will be on bonds and on leases. Okay, so that's where we're going, and let's just go ahead and take a look at what we talk about here with current liabilities. And the key thing about current liabilities here is that they are, liabilities in general are sacrifices of economic benefit, okay? We're going to have to give cash, most likely, is what we tend to think about a liability, but it could be that you're going to surrender some other asset. Okay. Now, when we talk about current liabilities, the key thing I wanted to point out here is really this 1 year sort of rule of thumb that we use for identifying a current liability. So if we're going to have to liquidate something, sacrifice an asset, usually pay cash or something, and we're going to have to pay that cash within 1 year, we will call that liability a current liability. Okay. When it goes beyond 1 year, we will call it, obviously, what? Non-current. Okay, now that's for our general sort of rule of thumb 1 year approach, but we also have this issue of the operating cycle, whichever is longer. So what happens? An operating cycle, just basically speaking, is how long it takes us to turn our inventory into cash. Okay, so if we're talking about a sushi restaurant, how long should it take them to turn their inventory to cash? A day, maybe two, okay? Certainly not a year, okay? So what would happen? A current liability would be one that would be used up in a year because 1 year is longer than the operating cycle of, say, a sushi restaurant, right? If we're talking about a winery, okay, well, winery, it might take, what, a couple of years to turn grapes sitting in a field into what? Into cash. So in that case, we could indeed have something listed as a current liability that what would not be, not be liquidated in, say, 2 years because of a longer operating cycle. Okay, so you select whichever is longer, the operating cycle or 1 year, whichever is longer. Okay. Now, when you come over, we take a look, and we are going to see that liabilities are often recorded at their present value. So we're typically going to be looking at the cash that's going to have to be surrendered to pay off this liability. We will discount that cash that's going to have to be surrendered, and that will give us present value. Okay, and we say that if we have a liability payable with 1 year, we could record it at its maturity amount, although frankly I think we're going to be using present value for the most part for liabilities. Okay, common example: accounts payable, notes payable. You can have dividends payable. We can accrue liabilities, and we'll talk about some of these processes and some of these different accounts as we go along. Okay. Now, when we're dealing with accounts payable are usually an instrument in which we have an open account. We have some sort of, yes, sir.
Sorry, is it possible IFRS standards that the liability should be recorded at their present value?
Liabilities typically are going to be a present value. IFRS doesn't differ much from that. Okay, the differences between U.S. GAAP and IFRS tend to be more minute than that. Okay, so they're not going to have one where they wouldn't use present value. I mean, that's sort of a common measurement techniques that's used both in IFRS and U.S. GAAP consistently. Yeah, you might have some differences in timings in the way they look at things, but for the most part, that major concept is not going to be different between the two. Okay. Okay, now we come over and we start to talk about accounts payable versus notes payable. The big difference is that accounts payable, or I should say notes payable is a written promise. Okay, is a written promise, and in order for it to be a note, it has to meet some very specific requirements. It has to have a time certain as to when it will be paid that will be stated in the note. There needs to be an interest rate associated with that, etc. Okay, accounts payable tend to be more informal. It's based on an open credit that we'll have with the supplier, etc. And the invoice is the document that will determine what the terms are with an accounts payable, as opposed to a specific, with a note dealing with a specific transaction. Okay, notes payable tend to be longer than duration. Most accounts payable are going to be paid off in what, 30, maybe 45 days. Okay, even sooner if they give us some incentive. You remember 210, net 30, those sort of terms. Whereas notes payable tend to be a full, at least a year. Or longer. Okay, you could have a shorter term note as well. You could have 60 days, not 60 days, but 6 months, that sort of thing. But they're, by comparison, they tend to be longer than accounts payable. Okay, so you can see that we have listed our accounts payable here, our notes payable in the current liability section. Okay, now notes payable, of course, could also be what? Could be non-current if they were to have a longer term, right? So the current is meaning that it's a shorter term time horizon. Okay, current portion of long-term debt. What's going on here? Well, we may have a note or a bond or something that we signed, say, 5 years ago, right? And at the time that we signed it, obviously it was long-term, extending out these 5 years, right? But what happens if that note now is going to mature the next year, right? We've held it for 4, we're in the last year before it matures. What should we do? We would literally have to reclass that long-term note out, or long-term bond, whatever, out of the non-current section and put it into the current section for our liability, so that the world knows that what? That is coming due soon. Okay, so we would simply reclass it out of non-current and into current. Okay. Now, when we talk about different types of payables, okay, we have our notes payable, we have commercial paper. Commercial paper has a very specific definition. For example, certificate of deposit could be seen as commercial paper. They tend to be short-term items, and there's a specific limit that we'll see here in a minute in order for it to qualify as commercial paper. A secured loan is a loan that is backed by what? Some asset. Classic example is a mortgage. We purchase a building subject to a mortgage. What they will do is they will attach that liability to the actual building. That's why they call it a mortgage. It's attached to that building, so that if there's some situation where we can't pay our obligations, the individuals that have attached to that particular asset, that building, will get paid out of the value of that building before the liquidation starts to go to any other unsecured loans. Unsecured loans, classic example of an unsecured loan is typically a credit card. What happens? If you charge something on a credit card and then later on you can't pay, they don't come after that particular asset. They'll come after you for the payment on the credit card bill, but they don't say, well, since you bought a stereo with that credit card, then we got the stereo first. That's not how it works. It's unsecured. Credit card debt tends to be unsecured debt. Okay, and then credit lines are typically where they will leave a line of credit open to us where we can go and borrow against that. So we'll set that up with the bank, and the bank will usually say, okay, you can borrow this much against this line of credit, and we go back periodically if we need that financing. Okay, now we come over, and stop me if there's a question, guys. If I'm not looking at you, just holler, okay? But we come over, and when we talk about credit lines, let's just jump into that a little bit more. And we can have a committed credit line, or we can have an uncommitted, okay? Uncommitted, committed means that we have a formal agreement, and it's a commitment from the bank to keep a credit line available to the company. So they'll say you have a line of credit of $1 million, and they have to keep that credit line open to us so that we can borrow against that $1 million as we need to. Okay. Now, if we have a non-committed, it's more informal, and we can borrow up to a prearranged amount without formal loan procedures. So in that case, they may not necessarily just leave that open for a specific period of time with us. They could pull that back at some time because it is a more informal agreement. Okay? Now, borrower may be required to maintain compensating balances with the bank. What does that mean? Sometimes the bank will say, well, look, we'll give you a line of credit, but we want a little protection against that in case at some point there's a problem paying back. So if you have $1 million loan, you have to maintain $100,000 on deposit at all times, sort of a collateral almost, if you will, against that line of credit. Okay? Okay. Uh-huh.
When you say the borrower only when needed, do they need to justify it, or is it just on their word?
It's basically on their word, on their credit.
Okay, I need this much. Okay.
Yeah, I mean, they may put some limitations in terms of, in other words, they don't want to give you a line of credit to borrow $1 million, and meanwhile you go and you borrow $1 million here and $1 million there and $1 million there, and all of a sudden, you know, you've loaned yourself into bankruptcy. So they may put in their stipulation certain debt to equity ratios, that sort of thing, in order to keep that open. Okay? Yes, so when we say justified, I'm pretty sure that for that it would be pretty much open for, you know, what the company determined they need it for. Okay? Yeah, these can probably get as complicated as you can imagine, you know, things getting and stuff. But typically, we're going to see that they're just going to leave that open, and then the company can go and borrow against that. Okay? Okay, interest. We obviously know that when you take the interest, okay, this is sort of an accounting, you know, introductory thing, but let's just go ahead and let's practice with this, right? So we have a loan. Say the face amount of the loan, the note, whatever, is $100,000. Say the interest rate is 3%, and say we borrow that money on November 1st. At December 31st, do we have to accrue any interest on that? At December 31st? So December 31st, we don't do anything. So we just say it's a 1-year note. So it's a 1-year note, and we have a 3% interest rate on that note. And we're sitting here, and that's the annual rate. And we're sitting here, and we reach December 31st. Do we have to do anything? Huh? Okay, good. So how many months do we have here? Okay, we issued it, what I said, November 1st? So we have all of November, we have all of December, right? That has gone by, so how many months? 2/12, right? Okay, whatever that would come out to. I didn't think that I was going to calculate that. What do we get? 100,000 times 3% is going to be, what's the interest on that? 100,000 times 0.03 equals times 2 equals divided by 12 equals what? Huh? 500? Somehow I got 72,000. I know that's not right. 500? Okay. So what's the journal entry there then? Journal entry at December 31st? Good. I'm going to debit interest expense for 500, and I'm going to credit what? Interest payable. Good. For 500, right? Okay. Okay, so I mean that's just a basic review there as to how we would accrue interest. But again, notice it was the face, the annual rate, and then time to maturity. I don't know exactly what they mean by time to maturity, but time that has what? Elapsed, right? Time to maturity is not correct because the time to maturity would be whatever it be now, at 9/12, but that's not what we're calculating here. We're simply calculating the accrued interest. Okay? Okay, good. Now we come over and take a look at a couple of examples here. Note issued for cash. Okay? So if the note is issued for cash, we do what? We debit cash, we go to the notes payable. This was a short-term line of credit arrangement, and it was 6 months, right? So this 12% note. So what are we going to do? We'll debit the cash, credit the note, and then we have what? Then we have this interest expense that we would take, and they just did it at the time that they paid the note off, which is $700,000 times 12% times the 6/12. At the time that we pay the note off, obviously we have to pay the person their note back, and then we also have to pay them their interest at that point in time, right? Okay. Now, this would work fine if we didn't do any financial reporting between May 1st and November 1st. What would happen if we wanted to issue, say, financial statements at May 31st? Did we have to do something? We'd go ahead and accrue 1 month's worth of interest, right? Okay, so we would go ahead and take the 700,000 times what? 0.12 times, in this case, it's going to be what? 1/12. It's going to be for the 1 month that's gone by, right? And we would go ahead at that point, and just like we saw in the previous example, on the previous slide, debit the interest expense, credit the interest payable for whatever this comes out to, right? Question? Okay, good. So let's go ahead and let's take a look then at a non-interest bearing note. Okay, and what happens with a non-interest bearing note? Well, they don't call it, they don't state out that the interest rate is such and such on the note. They'll say it's non-interest bearing, but then they'll go ahead and say that it has a 12%, and a 12% discount rate then would be used by multiplying 700,000 times this 12% times, and it's a what, 6-month note, okay? And it's times the 6/12. So what they're basically kind of saying here is that when we discount the note this way, that means that the interest is going to be paid by just paying back this whole 700,000. So the interest on this is the difference between the discounted amount and the what? And the final maturity amount. Okay. Now, when you look at something like this, they start getting into here how we would then have interest expense of $42,000. We would credit the discount when we pay the note back. We would debit the notes payable and credit the cash when we pay the note back. Okay, so if it's non-interest bearing, you're going to treat that as a discount. Now, let me ask you this. How would this be presented on the balance sheet? Right here. How would we show that on our balance sheet? Just using those accounts. Balance sheet. Don't worry about cash. Just give me the liability section of the balance sheet. I'll wait. And by that I mean I will wait. You want to show the notes payable? Guys, do we want to get into a mode where I just tell you to read the book and I'll just stand here and answer questions for the lectures? Is that what we want to do? I mean, I'm happy to do that. You know, let me say, hey, read the book. I'll be here at 12:30, and if you have any questions, you can ask them. Is that how we want to conduct the class, or do we want to have it be an interaction thing? Because I know how to do all this stuff already, so I don't need any practice with it. Yes, sir. No, that's not correct. The requirement is that we present a note payable on the balance sheet at its present value, which is what this 42,000, what this 658 is the present value, and then when it matures, it's going to mature to that future amount, which is going to be more, which is the 700,000. So the requirement in GAAP is that you present a note at its present value, which is going to be what? Is going to be the note payable. Now I wrote it in a place where I can't put the number next to it. Note payable is 700,000. Is that what you were going to say? Okay. And then we're going to go ahead and show what? The discount we'll call out there of 42,000. And then we will call it net note payable. And the net note payable is going to be the 658,000, right? Okay, this is the requirement of the FASB, that we report that note at its present value. Okay? Now, you're saying, well, how is that the present value? Well, if you were to take a look at this transaction, I'll put this up on the board here. We have $700,000 and $700,000 times the present value of the dollar factor, okay, is going to equal the 658,000 that was given to us in this example, right? As the amount that they received, that's the present value. Future value is the 700,000, right? Okay. So if you go ahead and you do the math on this, 600. If you were to divide each, multiply, I'm trying to get the present value factor. And so I'm going to have to take my, let's see my algebra here. Okay, so when I take 658,000 and divide it by the 700,000, then I should be left with the present value factor, right? And the present value factor here turns out to be 0.94, right? Okay, so if you look at the present value table, you look and discard that for now. And if you were to look at the present value table here, I said if you were to look at the present value table here, okay, you would see that we have what? We just have one period because it's what? 1 6-month period, okay? And as you come along and you look at that 1 6-month period, you start looking for the factor here, and the factor ends up being somewhere between 6 and 7%. So even though they're calling it a 12%, that's the annual, but this is showing you that it's what? Between 6 and 7%, right? Which is what is how we're recording at present value. And you're saying, well, what should I do with between 6 and 7%? Well, what you could do is you could sit here and take this 0.94 that we calculated as the true factor. 0.94 is the true factor. is the true factor. And then I'm going to go ahead and I'm going to pick up this, what, 0.94340, because what? The number is what? The next number is 93, isn't it? Okay. So I go ahead and I pick up this 0.94340. And when I do, I get a difference here, obviously, of what? 0.0034, okay, is the distance between those two. And then I'm going to sit there and I'm going to say, well, is the difference between what I saw the present value factor to be and the one at 6%. And then I'm going to look at the difference between these two, between the 6 and the 7. So when I look at the difference between 6% and 7%, and between 6 and 7, then I get a difference here with the 0.94340 versus the 0.93458. And that difference now here between the total between those 2 points is 0.00882. Okay? Now, what's happening? We're accounting for what? Some of that difference between the 0.94 and the 0.9430 is being accounted for here. So we've got what? 0.034 has made up what? Has made up this percentage of the total difference, 0.00882. Okay? So when you do that math right there, you get this 0.385 48753. And if you take that number and do what? Add it to the 6%, then the real interest rate on this thing is what? 0.0638548,753 is the true interest rate on this thing. It's not 6%, we know, because what? 6% is going to be at this 0.94. We know it's not 7% because that's at 0.93. It's in between the two, isn't it? Okay. So the interest rate here that we use to come up with this present value is not quite 12%. Okay. So the company would have determined, probably using some sort of financial calculator, you know, because we have what? Increments of rates that aren't shown here, right? And if they determined that the interest rate they wanted to use was 6.38 whatever, then what? They would have come up with this present value this way, this 94,000, and that difference between the future amount and the not 94,000, this 0.94, the difference between this future amount 700 and 658, that's the future value. And when we report the note, we report it at its that's the discount, and when we report the note, we report it at its present value. So it's going to be the face minus the discount here. Okay? So the takeaway was what? Face, I'm not going to make you get into interpolating interest rates on a present value table. The takeaway here is what? You report that note at present value, right? I'm just showing you how it was present value. There was the factor, and pretty much we were pretty close to that 6%, which they called out as the discount rate, but that is different than the effective rate. The effective rate is whatever brings that to present value. And when they loaned us the money, they would have said what the interest rate was, and they would have figured out what the present value was that they were going to give us now, and then we pay them back the future amount. Okay? All right, so we come over and we take a look at this. We just were, okay? And I am going to hold you accountable to knowing that what? We would set the journal entry up this way when we issue the note, right? we would report the note, as I stated, at what? Present value. So if I asked you what would be the, carrying value of that note, what would be its present value, you should know the answer is the 658, right? Okay. Then what? Then we come over, and when we actually pay the note off, we of course have to give the guy the $700,000 cash, and the discount amount is my interest expense now, right? Right? You borrow money over time, you pay back more in a future date. That is, in most cases, interest, right? Interest expense. When I say most cases, not-for-profit organizations have a different way of looking at differences between original present value amounts and future amounts that are collected later, etc. But just for the purposes of our discussion here, we can just assume that that's going to be interest expense. Okay? Okay, good. Now you come over, and they start to show us how to calculate the effective interest on this. Okay? Now notice they tell us that if you borrow $42,000 for 6 months, that comes out to an interest factor of interest rate of 6.38. Okay, so what do they do? Take 42,000 and divide that by 42,000, and they divided that by what? 658,000, and that gave them this 0.0638 to 6.38, right? Okay, and what happens? Notice that in a more cumbersome way, we can take it back to the present value table. Is that the same number? Okay, so it is still going back to what? To this idea of what is the present value, what the true interest rate is on this. So there's a difference between the term discount rate, which is what? Which is assuming, okay, 12% interest is what we're charging on this for the what? For the 6 months. So it kind of approximates the discount on that, and then we have to pay the person back the full amount at the end of $700,000, and that difference is my interest expense. But you can't just say that the interest rate is what? Is 12%, because what? Because we're not ignoring the time value of money in the way we're accruing this interest, or not accruing this interest, but bringing it to present value based on a 6-month note. And so to actually calculate the effective interest, you would go ahead and you would take the amount that you're paying in interest divided by the amount that was borrowed. That gives you your true interest. And since, how many 6-month periods are there in a year? 2. And so since there's 2 6-month periods in a year, and they do 12 divided by 6, just figure out the number of periods that are being accrued here, which is, it's a 6-month note, so we have 2 6-month periods in there. We multiply that by 2, so the effective interest is 12.76. So it's not quite 12%, is it? So there's a difference between what? Between the discount rate and the what? And the interest rate, the effective interest rate on this note, right? Okay. Question? No, like I said, I'm not going to hold you accountable. My option would be to show you a formula or to show you on the table. Not show you on the table. If you plug all those numbers into a present value formula and you know what you want your interest rate to be, I mean, that's really how they come up with the discount, is they would use a financial calculator and say, well, we want to charge this person 6.3892 interest because that's the going interest for a car wash. So let's just use that as an example. They plug that in and they say, okay, if you're borrowing the money for that and you were going to, even though we say it's a 12%, it's going to be 12% discount, here's what you have to give us, right? And they come up with that present value, and we call that a 12% discount rate. But the actual effective interest rate is calculated by doing it, and this is the quick way to do it. I'm just trying to show you the relationship between present value and this. Okay? And again, the point of that, what is your name again, sir? Corey? And again, the reason I did that is the takeaway from that example, because I know you see something like that and you think, oh God, here comes a full-blown free response question where I'm going to have to interpolate interest rate from the present value table. I'm not going to do that to you. The point that I do want you to take away is when we report the note, we report it at what? It's reporting it at present value, isn't it? It's the face minus that discount brings it to its present value. Okay, good. So we come over and we talk about secured loans. Okay, now what happens here? Let's say I want to borrow some money from you, and I come up to you and I say, hey, can I borrow some money? And you say, okay, can you give me some collateral? And I say, how about this desk? Anybody want this? I mean, I think we could move it if we wanted to, right? So you say, no, thanks. You got anything else? And I say, well, in here, I have a book of accounts receivable. And what I'll do is I'll go ahead and I'll give you those accounts receivable, and then you go collect on them. How about that as collateral? You might look at that, and you'd probably do some due diligence, but you'd say, okay, yeah, you'd probably, which, again, this isn't the auditing class, you'd probably have somebody do something called agreed upon procedure. And in the agreed upon procedure, what an auditor, a CPA would do is they would go and probably do something like confirm some of those receivables so that somebody says, yes, I do really owe John, $15,000. You'd also probably do some back checking to see what the collectability rate was on those receivables, because even if somebody admits that they owe me money, maybe they can't pay me, okay? But we call that agreed upon procedures. We would agree as to what procedures the lender was going to be happy with and that I would agree to go through. And at that point, we'd get some sort of report that talked about the outcome of those procedures that we did, and you would get some comfort level that indeed you're going to be able to collect those receivables. Anyway, there'd be some audit procedure around that, okay, some assurance procedure around that. But you look and you say, okay, it's a pretty good receivable based on that, right? So what happens? Now you're willing to take that book of receivables collateral for the loan, right? Have I given up? Have I surrendered those to you at that point? No, I've simply pledged that as collateral in the event that I can't pay. So what we would do is we would leave the accounts receivable on the books. I would still show that I have this account receivable, and then there would be a footnote that would say, by the way, there's a lien against those account receivable. They have been pledged as collateral against the loan, whatever it is. Okay? Now, factoring is different. Factoring is where I would go and I would actually try to sell you those receivables. Now, they don't show it here in the presentation. This chapter doesn't get into it, but when we're dealing with factoring, we can factor with recourse or without. Did they talk to you about this in number 1? Intermediate 1? With the receivable? Yeah? Okay, with or without recourse. Okay, if it is a with recourse, then what? Then it could be potentially treated as collateral, meaning what? Meaning that in the event I don't pay you back on the loan, your recourse is to do what? Come back and take the receivables back from you, right? So if it's that sort of thing and we have factored those with recourse, then what? I will give you the receivable, you keep them, and I just get cash for that, right? I just get cash for that. And your recourse would be to do what? To come back to me in the event you can't collect on those and say, give me my money back, right? And if that's the case, then it's really just what? It's just a loan in which the receivable is collateral, right? If I give you the loans and you can come back to me and say, give me my money back, then in effect, I still own those receivables, right? And so I would still carry that on the book and just footnote that it's been a pledging, I might call it a with recourse factoring, whatever, okay? Now, if it is without, that means you can't come back on me, right? And if you can't come back on me, I will literally remove the receivable from my books and show that I have sold those outright. And there'll usually be a little difference between the factor amount and the carrying amount. Why? Why, let's say I have receivable of 1,200 and I factor it to you for 1,000. Why would I do that? I have accounts receivable coming in at 1,200. I give it to you, you give me $1,000. It's without recourse. So you can't come back to me if you can't collect. Why would I be willing to do that? Right. Well, I'm giving you, and I'm putting myself in the position to borrow here. I'm giving you what? You're not even a borrower. I'm sales. I'm a seller, right? And it's without recourse. So what happens? I'm giving you $1,200 of receivable, but I'm only getting 1,000 back. That's because what? You need to make a profit on this whole deal, don't you? Okay. And all I'm saying is, if it's without recourse, then we're done. I'm going to take the liability off the books. I'm going to take the account receivable off the books. There's not going to be any note payable associated with this because I essentially sold it to you outright, right? And if you can't collect, too bad, you lose, right? Okay. All right. Now you could also have a factoring with recourse, in which we will still treat it as a sale if the only thing I have to give back to you is not your money, but instead I have to give you back similar receivables. So let's say these are my accounts receivable, and I go ahead and I give them to you. You give me cash, okay? And the only recourse that you have is to come back and ask me for other receivables. So let's say you can't collect on two of them. So you can't collect on these two green ones, right? So what do? I sit here and I say, okay, well, that's all right. Try to collect on those two. Did I give you cash back? Didn't give you cash back. I essentially gave you what? Other receivables, okay? So if I don't have to give you the cash back, if I sit there and I don't have to give you the cash back, even though it's a with recourse, we can still treat it as a sale, right? But if the recourse is I got to give you your money back, then we would treat it as a pledging, okay? You've got pledging, just pledging it as collateral. You got factoring. Factoring is what? Could be a sale, or it could be what? Like a pledging. It is what? A sale if it's without recourse, or even if it is with recourse, if all I have to do is give you back other receivables to collect, then we can still treat it as a sale. If it's what? If it's with recourse and I have to give you your money back, then we're back to this collateral approach. Okay? Okay, they don't say all that in the slide. Question? Okay, good. Commercial paper. And remember I said that what? Commercial paper tends to be a specific short term. Commercial paper is usually between 30 and 270 days. And if it goes beyond 270 days, then we have to do some filing to issue that debt with the SEC. Okay. Typically, these are very large, corporations that are going to be issuing these commercial paper. Classic example is just a certificate of deposit, short-term place to put your cash. Okay, accrued liabilities. Okay, we have some examples here of different accrued liabilities. Let's just jump to the numeric examples so that we don't make more out of this than it is. We borrow what? We borrow this cash of $700,000, and then they tell us that it's a 6-month note, 12% interest, and we borrowed the money on May 1st. At June 30th, how many months have gone by? 2. Okay, now I always ask that kind of, obvious question, I guess. And the reason I do is it's just, I see it all the time on exams, guys. Be careful. You get in a hurry and stuff, and you sit there and you say, okay, May to June, that's 1 month, right? Meanwhile, it was all of May and all of June, right? And don't be ashamed to just count it out on your fingers. Don't feel like you got to sit there and try to do it in your head. That's why God gave you fingers, right? Is to count how many months in accrual of interest, right? So it's what? It's all of May, all of June. It's 2 months, right? Okay, and so at the end of June, for those 2 months, we would debit interest expense. We would credit interest payable. Why are they doing this the end of June in this example? I guess they're assuming that this entity prepares quarterly financial reports, and they were going to go ahead and prepare those after 2 months, right? I mean, you don't have to accrue these. Sometimes you'll see in textbooks they do it every month, whatever. It really depends on the company's accounting policy, their reporting timelines and stuff, right? Okay. Okay, now you come over and you take a look, and then when they go ahead and they pay the note off, now this is November 1st, now we've gone the full 6 months. I guess we accrued interest last time at what? June 30th, so now we've gone through how many months? All of July, all of August, all of September, all of October. Don't count November because it's November 1st, right? Okay, so we got 4 months here. So they go ahead now, they're taking the interest expense for those, the back 4 months. We're now paying off the interest that we had accrued at June 30th for the 2 months. And of course, we have to pay back the cash, right? In the full face of the note. Okay? All right, good. Pretty easy, right? Let's take a look at vacation. Okay? Now, what happens? We will recognize vacation if it is based on services that have already been performed. So when we look at some of the examples here, we're going to say that the individuals have already worked, they have already earned their vacation, right? And now we're going to be accruing the expense for work that they've done to which there was vacation that was accrued, okay? The paid absence can be taken at a later date, so the benefit has to vest. Most vacation time will vest year to year, right? And if the employees carry it forward, then it stays on the books as a liability going into the next year. Payment is probable, okay? You know, if you tell somebody you have vacation time and they earn that vacation time, try not paying them, okay? You're going to get a knock on the door from the Department of Labor at that point saying you can't agree to pay somebody and then back out after you've already agreed that as part of their compensation. And then, of course, we have to be able to estimate the amount. Now, this issue of being able to estimate the amount and payment is probable, okay? It works for causing us to typically accrue vacation. Can you determine if it is probable that you're going to have to pay sick leave? Or can the amounts be reasonably estimable? Okay, that gets a lot tougher, doesn't it? How sick are people going to be? How fast? Right? And so this is part of the reason that you have all this debate with the healthcare thing now. And then what? You can put up a bunch of different assumptions up there as to how, you know, healthcare, you know, is going to have to go and what's going to be involved. And it starts to become very, very complicated very, very quickly, doesn't it? So what GAAP allows is for sick leave, typically, we'll see the companies aren't going to include a sick leave. Question? No? Okay. All right. So let's just go ahead then and let's take a look at this example. And we've got these employees, and I don't know why this slide is doing this. It's $600 per week, guys. I'm not sure. I tried to fix it, but it went back to where it was. So it's all right. So it's $600 per week that they're paying. That's all that little note is saying down under there. Yeah, I'm not going to fix it. I wanted to fix it, but forget it. You can figure it out, right, that it's 600, okay, that they're paying per week. And then they tell us that they have 8,000 employees, each earn 2 weeks of paid vacation per year. Vacation time not taken in the year earned can be carried over. So we've met that requirement of what? That it is going to carry over into the next period, right? Okay, and it's obviously estimable. We know how much they're going to make. We know the hours, okay? During 2018, 2,500 employees took both weeks of vacation, but at the end of the year, 5,500 employees had carryover time as follows. So we see that we're sitting here and we have what? We have 2,500 people have used up all their vacation. We've got the what? We've got the 2,000 and the 3,500 now, the remaining employees that have what? Carryover weeks for people that have used 1 week. They have 2,000 worth of carryover weeks for those 2,000 people and what? 7,000. So we've got a total of 9,000 carryover weeks that we're thinking they will take into the next year, right? Okay. So what do? Well, for the 0 employees, we don't do anything, right? We don't have to worry about them. But for those 2,500 that still had 2 weeks, we're going to do what? We're going to take part of that 4.2 million for them, and then what? And then we'll take, for those people that only had 1 week left, 2,000 of them, just going back to that table, right? 2,000, not employees, but hours, 2,000 hours of these guys, right? And then we've got the 7,000 hours of the other guys, so we go ahead.
Where does the 600 come from?
600 was that number that was covered up down here. That's their amount. Yeah, that's the amount that was covered up down there. And so for these guys, we've got what? The 2,500 that had 2 weeks at 600, and the 2,000 that had 1 week at 600. So we go ahead and we accrue that pay for those individuals. Okay. Okay, so then when we get into the accrual, we'll go ahead and notice we went ahead and we paid them their salaries for those individuals that had taken time. We paid them their salaries. We credit the cash when we pay them. Now, for these individuals that haven't taken any time yet, remember the 9,000 carryover. There's the 9,000 that was carried over. We take the 9,000 that was carried over. Let's put all that on one slide. 9,000, and that's the 600 a week, and we accrue for those hours that are left, right? That's a liability because they've already done the work that caused them to generate that vacation pay, right? Okay. Then in 2019, when they take their vacation, we debit the liability, and we, of course, going to pay them their cash, right? Okay. Now, you're saying, well, where's this 300,000 coming from? Well, the 300,000 is coming from an assumption here that's kind of not explicit from the way they presented the information. What if the salary rate changes as you go into that next year? Well, when you actually pay them, the guys are going to say, well, since I earned that last year, only pay me $6 an hour, right? That's guy is going to want his vacation at what he's actually making at the time he takes the vacation, right? So that additional amount would be taken as this additional expense if you're paying him a different amount by the time you actually get around to paying him. Okay?
What is the actual expense
You mean we had like a cut in pay? Then we would debit the liability, and we would have to credit salary and wage expense. It would actually reduce our wage expense, right? Again, guys, remember, this is an estimate. And remember what we said about changing accounting estimate, you do what? You just go forward with the new estimate, right? So even though you had taken expense of $55,400,000 in 2018 for these guys, and you set up the liability, sorry, we thought that was the correct amount, but it turns out that our salary amount was a little bit different, wasn't it? Okay, and if it's less, then you will actually credit salary and wage expense for that lesser amount. If it's more, you debit salary and wage expense, right? And you look at this, you're thinking, you know, you debit it, but they earned that last year, didn't they? Didn't they earn that last year? Right, and we're taking it in 2019. Change an accounting estimate, because it gets difficult to know exactly what people are going to be making, you know, next year. Maybe there's a labor negotiation that has to go on or something, and we don't know exactly what that rate's going to be. So we take it based on our best estimate of what we think the amount's going to be when we pay, but there will likely be a difference, right, between we actually pay them and when they're taking the vacation. So we go ahead and just make that adjustment accordingly. Next year, it might be that we have to back some out. Oops, we overestimated what we can take. So it wouldn't even necessarily have to be a cut in pay. It could be we overestimated what the rate was going to be, right, when we actually pay them. Okay? Okay, good. Come over. And let's take a look at some liabilities for different things here. Advances from customers we're going to see are essentially going to be going to be considered a liability until we meet the criteria for the advance, whatever it is. Gift cards, okay, and we're going to see that we're going to be having to estimate to what extent those will actually be redeemed, and collections for third parties. We're not going to say much about that. Essentially what we're talking about is you withhold taxes, right? And then you have to remit those to the state and federal government. Do you want to go through that now, or you want to take the break now? Keep going or take a break? Huh? Break? Okay. Okay, so why don't we go ahead? That seems like a decent stopping point. So we'll reconvene at 1:45. Okay? Probably seems like a good spot to stop, and we'll get back to these. Zoomed here, and let's talk about some of these refundable deposits. Okay, so if somebody gives us a deposit, is there a question, guys? Okay, I mean, the one thing that you're going to see consistently with me, I don't want to talk over, other folks, so it's fine, whisper a quick thing every now and then, but once we start the class, right? So we have what? We have these refundable deposits, and when you look at these questions with all of these sort of gift cards and that sort of thing, they almost become more of a reading comprehension thing than an accounting. I mean, the question will tell you this is what they plan to do. Okay, so we have a refundable deposit, and it is collected on containers, and deposit is forfeited if the container is not returned within 1 year. They say 90% of the containers will return within the allotted time, and deposits charged are twice the actual cost of the container, and the inventory of container remains on the company's books until deposits are forfeited. So, since it's $300,000, you got to give a deposit. They give you the container, whatever. You debit the cash, you credit this liability because you have to give this money back, don't you? Okay. Now, what happens? Again, like I say, it's reading comprehension. The problem told us, okay, 90% of them came back. So obviously when they give the container back, we give them their deposit back, right? For 90% of that, easy enough. These remaining 30,000 didn't make it. So they did not return the container within the 1 year. And so we're going to go ahead and debit the liability now. And we actually have what? Revenue. We're considering those containers have been sold. And then they said that the cost, the deposit amount was twice the cost of those containers, so we would debit cost of goods sold and credit the inventory of containers. Question? What if it's a non-refundable deposit? What if they give me the deposit and I don't have to give them the money back? Can that happen? Does somebody have to give me a deposit and I don't have to give it back? It's non-refundable?
Is it a deposit thing?
Huh?
Is it a deposit?
Yeah, it's still a deposit. They can still call it a deposit, okay? But I don't have to give them their money back, and they still have to give me the container back, right? Okay? Now what? Huh? You have to, again, read the question, okay? It probably would not be appropriate to take the revenue immediately, okay? But there would be something in this question where they say, the company considers the deposit earned after half of the contract period has expired or something like that. And then so you might take half in the, take it after half the period has expired, and you would take it as a revenue. Okay, so you can have non-refundable deposits as well, and you would just have to read to see what it is that they determine the triggering event to recognize the revenue. Okay, now you take a look You know, you guys are looking at me like, no way. Well, why even put the word refundable in front of the word deposit if there was no such thing as a non-refundable? Okay, there's both. We're just not mentioning it. Yes, sir.
But usually non-refundable deposit is part of the cost, right?
Part of what cost?
So like they benefit of the
Well, again, there is no gap rule that says, okay, you have to take it at the end. They have to come up with a reasonable period of time that they consider that non-refundable deposit to be earned over, and that's what they would use. It's not like GAP comes down and says, you can't take anything until the contract is over with. That's not a generally accepted accounting requirement. Okay? The rule is they need to look at the nature of the transaction and see when they believe that enough has occurred that they've earned that. If you're saying to me, well, the nature of the transaction is such that they really haven't earned that non-refundable deposit until the contract is over, then that would be the answer. But the company could say, well, no, we consider that, that we don't have to refund anything after a year of a 2-year contract, whatever. Then at the end of that year, that's when they would take it. Okay, all right, now you come over and we talk about advances from customers, these different things. Now, they talk about advances from customers, guys, and we start giving you examples of gift certificates and magazine subscriptions, etc. And, this gets a little scary because airline tickets, you start thinking you're going to have to sit here and learn the specific accounting for 5 different industries up here. Okay, and it turns out that it is not that much different than unearned rent revenue. So let's say I have an apartment building in Berkeley. It's in the hills up here, nice area, whatever. And it's a 5,000 square foot apartment, and I tell you that I'll rent it to you for it's brand new. Got all the tip-top stuff. You can even look at it and tell me if you like it. I'm telling you, it's gorgeous. And I'll rent it to you for $1,200 for the entire year. Is anyone interested? Is anyone interested? It is always easy for me to determine when people aren't following along with the material of the class by the look of pleasure on their face. Okay, so if you have a pleasurable look on your face, I know you're not looking at the material in this class. Okay? And so, I've got all kinds of tricks for figuring it out. Okay, other times, what I'll do is those windows will be open if it's a night class, and I can see the reflection of people's computers straight on the windows, and I'll say, you, stop looking at something else. You're like, how do you know? I can see the reflection, okay? So stay with me, guys, okay? You got to stay with me on this stuff, okay? I know that it's summertime and this is accounting and it's boring and all that sort of stuff, but if you're bored with accounting, get used to it, okay? You decided to go this far, you're stuck now, okay? All right, so what happens? We sit here and we have this apartment building and I want $1,200 up front. So if you give me $1,200, do I debit cash? Right? Okay. And then I'm going to credit what? Unearned revenue for $1,200. Right? Because I haven't earned any of that yet. You gave me the whole year up front. Okay, now 1 month goes by. Have I earned any of that? 1 month goes by, so I'm going to do what? Debit unearned. My pen is going to give me a hard time. Debit unearned for 100, right? And credit the revenue. We don't call it earned, right? We're past the stage where we have to call it earned revenue. We're big accountants now. We know we just call it revenue, right? Okay. Okay, good. Now, is that hard? No, it's not, right? Now you look at these other things, you say, well, John, these other things aren't going to be that simple. And yes, they are. It's going to be simply a matter of what? Reading what the problem is saying and then following the what? the pattern that they're talking about, right? It's going to be a 1-year deal, and they got this much under the 1-year deal, and this much time is expired, etc., right? Okay, so you come over. I'm just, kind of giving you a sort of a thing to link on as we go through these different things, and we talk about what some money was collected in advance. Tomorrow publications, magazines, subscriptions from customers at the time of subscription are sold. Subscription revenue is recognized over the term of the subscription. Tomorrow collected $20 million in subscriptions in its first year of operation. At December 31st, the average subscription was 1/4 expired. So that means they've earned what? 1/4 of this, haven't they? Okay, so it's very simple. You just say, okay, 20 million, whatever, divided by the 4 means that 5 has been earned, right? Just like 1/12 of the rent had been earned on that thing. I could have said, Lord Buildings had these issues where they make us pay in advance for the rent at the end of 1 year, or whatever, how much has been earned, right? Okay, and you would have said, what, $100 in that example, if we were using my example? Okay, good. Come over, and we can have cash received on gift cards, okay? And you could have them on redemption. They will recognize the revenue, or on breakage, which is the what? Now it's so far out, it's on the remote probability of redemption. This is me. I'm telling you guys, I've got in my drawers somewhere, my drawers at my house, I've got gift cards sitting there. I know I do. And every now and then I sit there and think, I got to go look, and I know there's like a gift card in here somewhere, and I just lose them and I forget. And now I don't know where they are, So some people are like me, right, and do that. Other people run to the store immediately and use their gift card. That's these people, right? And that's when they can take the revenue. It was interesting, and I can't remember how we finally resolved this. I was on the audit of the Bureau of Public Debt. Remember when I threw up those debt numbers up there the other day, and you're like, what does this dude look at the debt every night? And once we audited that debt number, it kind of sticks in your head, and you kind of are aware of it and kind of watch it as it goes along over the years by administration and stuff. Anyway, one of the things that we were looking at when we were looking at the public debt consists of T-bills, notes, bonds, these sort of things that are redeemed pretty much on a regular basis when they become due. But then you have this issue of savings bonds. And savings bonds are things like somebody's grandmother sends them a $50 saving bond or something, and what? They lose the thing. People lose them. And the question was, what should we do with those savings bonds that have been outstanding now for years and years and years? What is the chance that someone's ever going to come back and redeem those? And I have to tell you, after I've set up that interesting story, I don't know what the answer is. I don't know what they did, because it was, number one, an immaterial amount. It was early on in the engagement that I was still part of the bigger team talking about those sort of things, and then they put somebody on this immaterial amount, and I took over the auction issue cycle, which at that time they were only auctioning, $2.5 trillion of debt a year, and so obviously my attentions got drawn elsewhere. But I just thought of the fact that they did have to worry about that, and they could have treated it something like this, although the government tends to be a little more conservative about stuff like that. But we have those that call it on breakage. If they feel that somebody's not going to redeem it, then they'll go ahead and they'll take the revenue for that. Okay? So we go ahead and we take a look at this Great Buy Inc. has 2 million of gift cards. Also during May, there's 1.5 million of gift cards sold. Also in May, 1.5 million of gift cards sold in prior periods were redeemed by customers, and 1 million of gift cards sold in prior years, they had that breakage, they were expired unused. So we come over, and the journal entry for the 2 million that were sold, it's going to be deferred revenue, unearned revenue, just like when you gave me the cash for that apartment building, right? Then what? Then when the people redeem the cards, you go ahead and debit the deferred and credit the Credit the revenue. And then to record the expiration of the gift cards, we're going to go ahead and debit deferred gift card revenue, and we're going to credit the revenue for those that have expired. Okay? If you're waiting for deeper meaning, stop. I mean, it's just a matter of what? Those two buckets, right? Those that have been redeemed or earned, those that have expired are also considered revenue, right? Okay? So now, when you give a gift card during holiday time, you can write on the card, please use this before breakage, right? And people will be, what does that mean? Before it expires or whatever, right? Okay. All right. So let's go ahead. And if the gift card doesn't, by the way, have to call out an expiration, you're thinking, well, what if it never expires? At some point, they can still make an estimate of what they think the amount is that won't be redeemed, right? And they may have God-made computers for those sort of analysis, right? Where they'll sit there and analyze after so many years, this is the percentage that actually gets redeemed. They go past that period, that's the amount that they would be, the amount that's not going to be redeemed is the amount they would put in as the revenue. Okay, collections, payroll taxes. Not getting into that. Okay. We can get into, though, a little bit sales tax. Okay. And if it's 4% for local and 3% for state, you make a sale, you have sales taxes payable, right? Is there anyone who's interested in that number? No, I don't mean in this class. Can you think of somebody who's not in this class that's interested in that sales tax payable number? Can you think of anyone who would audit that number to see that it's right, huh? The government, absolutely, right? They want their money, don't they? Okay, I mean, the stores held that money for them, and they want to see that they're getting remitted the right amount. So they will come down periodically and audit that number to make sure that you reported the right sales revenue and thus the right sales tax, right? What's the name of that entity? SEC is the Security Exchange Commission. SEC does very little of direct auditing of anything. What SEC does is they come back in and they will oversee certain, audits that were done, et cetera, and look at companies. The main thing the SEC does is an enforcement entity, right? And so what they're going to do is when there's, allegations of problems or whatever, or problems get identified, they're going to come in and probably punish the bad doers, right? And disgorge them of their ill-gotten gains, those sort of things. Okay, is the main thing SEC does. And we're talking state and local governments here. There's not really a federal sales tax. Might be an excise tax, but for the most part, there's not a federal sales tax. The name of the entity, and this is the state level that I'm talking about here, we don't have a lot of city, well, I guess we do have some city taxes, local taxes in the Bay Area, but the entity that I'm thinking about is the State Board of Equalization. So if we're talking state income taxes, you have what? The State Franchise Tax Board. Okay, but if we're talking about what? We're talking about sales tax, it's State Board of Equalization. Okay, and a lot of times students say, "Oh, I don't want to work for the government. I don't want to work for the state." Well, think about it. If you work for the State Board of Equalization, what would happen to you? Well, you might be put on an assignment where you're looking at a mom and pop 7-Eleven store or something, sales tax return, and that might not be that exciting. But you might get on Apple's sales tax return, and now all of a sudden you're looking at how Apple has done what? Has recognized their revenue over the period and reported that to the government, et cetera. That might be something that would be a useful experience for you. Okay? Okay, good. By the way, guys, I want to make clear that being in attendance and being here for the quizzes, etc., gives you how many points? 17 points total over the course of the class, right? And when we get to the end, I am going to be taking attendance and making sure, because if you're not here, I put a 0 in there for you, right? And if you add that up, in every class I've ever taught at every institution, I get the one person who says, is there any way that I can do something to get a better grade? And the first thing I look at is, what was the person here? And my comment would be, yeah, get in, go into a time machine and show up in class at 12:05 on whatever today is, July 11th, and present yourself, and I'll give you an A in the class. See, nobody did it. Okay, so, make sure that, we're sitting here and we're, keeping up the attendance, because I'm going to take attendance at the end. I just wanted to let you know that. But I'm preaching to the choir here a little bit. Okay? All right, good. So we go ahead and we take that liability, because we're going to remit those taxes to whoever the taxing authorities are. Okay, good. Let's go ahead. Let's take a look at this one. Perkins accepted advance of $2,400 on December 1st for providing IT help services for the following 6 months. Perkins estimates fulfillment of its performance is based on the passage of time. Again, how we take these is really up to the company to determine their operations, right? And all they have to do is be reasonable and rational in how they come up with that. On December 31st, 2018, Perkins will make an adjustment entry to include a credit to revenue. Well, before we get to the revenue, what's the journal entry for this money that came in? This $2,400. Debit cash, $2,400. Good. I guess I should stand up straight while I do this. It's not so. Yeah, and then the Raiders lost. So I'm sitting here at a bar or something. Okay, so what? We've got $2,400 cash, and we're going to credit what? Unearned deferred revenue. Okay, I'm going to go ahead and put unearned. I'm not sure what they call it. Those are synonymous terms. There's no requirement that it be one or the other. I'll go ahead and put unearned revenue. That says unearned revenue for $2,400, right? Okay, good. Now, the term of the contract is how many months? 6 months. So we've got what? 2,400 divided by 6 is going to give us $400 a month or something. Okay. And what? We got 1 month. So it must be that we're going to debit the unearned for 400 and credit the earned, right? Just to put this in format of journal entries. Right? Okay. All right, good. So let's do the little ring toss and see if we got the right answer here. Oh! Okay. It's now scribbling all over the answers. Let's just leave that off. All right, so you kind of see what I'm saying, that when it comes to stuff like this, how much it's more reading comprehension than anything. I mean, obviously, if I ask you the journal entry, there's accounting there. But other than that, it's just sort of just reading through the fact pattern.
Is that the kind of question that we'll have
yeah. More likely, it'll be like the ones in the quiz, though. Okay, so you should always go by the quizzes more than the examples. But what I do is, this is how I prepare the class for you. I go through and I look at the slides. I pick out, what I think are the key points that you should be taking away from the slides. And I'm not here teaching the CPA exam, guys, but part of my filter is this person may potentially going to be sitting for the CPA exam. This is the kind of stuff that the exam will hit on. So these are things that I really, really focus on. But other things that, even though I don't think the exam's going to test it, I'll still talk about it because I think it's particularly relevant to, business transactions, etc. But I'll do that. And then I will go through the test bank and I will pick out questions that I think hit on those key points. And I'll pick out 10 to 20 of those questions and I'll put that in the quiz. We go through the quiz together, and then when I prepare the exam, I try to find questions that seem like they're similar to the quiz questions. I will say, though, that I do tend to add a little bit of a requirement to look at things a different way. For example, let's say in the class we studied bonds, semi-annual bonds, the whole time, right? In the quiz questions, I give you semi-annual bonds. On the exam, I might give you an annual bond because I expect you to be able to make that jump from something that we've done every single time to, now something that's maybe going to have a little bit of a different pitch to it, right? Because that's how the world works. You can study this all day, and then what does the world do? Ha ha ha! And it gives you something else that's a little bit different from that. I'm not going to make it completely different, because if it's completely different in the real world, you'd go to somebody and say, I have no experience in this, right? And you would ask. And by the way, during my exams, you can ask me, and I will try to help you without telling you the answer to the question, because I believe that part of the process of performing is using this given ability to speak to each other, right? And if I can give you a little help and that nudges you in the right direction, that simulates the real world as far as I'm concerned. Does that answer your question, kind of, sort of? Yeah. Okay. Okay, now you come over and you take a look at this one with gift cards, and it's 30,000 gift cards. Also, during 2018, $25,000 of gift cards were redeemed, some of which were sold in 2018, and some of which were sold in the prior year. I don't care. Doesn't matter when they were sold. The point is that it's what? Being redeemed now, right? Okay. Then what? Ling also concluded that 2,500 gift cards sold in the prior year would never be redeemed. Those are those breakage ones, right? Okay. And so Ling finished 2018 with a balance of 17,500 in deferred revenue. Gift cards, Ling should recognize revenue. This doesn't matter. I don't need this either. Okay, I just simply need to know what has matured, or what has been redeemed, I should say, or what has broken, right, to get the revenue. Okay, so they give us this 227,500. It'd be nice for them to show us how they got that. I guess it's pretty self-explanatory. It's what, 25,000 were redeemed. Did they show it? Maybe I have to click again. Yeah, there it is. Okay, so it's 25,000 were redeemed plus what? Plus the 2,500 that were broken. Okay. Okay, good. Okay, let's take a look at current and non-current. Okay, and the requirement that we reclass a liability that we may have been carrying as non-current for years, and then that thing's going to redeem next year. So it's a 5-year note, 5-year bond, whatever. We carried it non-current in year 1, year 2, year 3, and then what? We get to the end of year 4 now, and we're going to want to show that as current because it will mature in what? In year 5, right? And we literally reclass it out of non-current and into current. Okay, now they don't show us a journal entry here because I guess it's the world's most boring journal entry, because all we're going to do is debit the non-current. So let's say it was a note payable non-current, and we'll debit that, and I'm just making numbers up, guys, 100,000, and we'll credit what? Note payable current. Make sense? I promised you it was a boring journal entry, and it is. It's just simply taking it out of the non-current and doing what? Putting it into the current, isn't it? Okay, that's all that happens, okay? Now, they give us a bunch of different examples, and they tell us that we have a 20-year bond, long-term liability for 19 years, and then at the 20th year, well, I don't agree with those numbers. I'd say it's at the 19th year. Because what? At the end of the 19th year, it has to be shown as what? As current, right? Okay, at the end of the 19th year would be more appropriate. So it'd be, I guess they're saying 19 years at the end of the 19th. Okay, I guess that would be 19 years at the end of the 19th. These are the kinds of things you're burdened by as an accountant. You think about all these kinds of things. For example, I heard that the Oakland A's are going to celebrate their 50th anniversary of being in Oakland next year, because they came here in 1968 and next year's 2018. I was talking to a friend of mine, and I'm like, they really should have had that celebration this year, because this marks the 50th season, because that first season was a season, wasn't it? 68, so it's actually 50 years this year. And my friend goes, you know, you're the only one that would come up with that one. Okay, so you can drive yourself crazy with this stuff. But anyway, so it's at the end of the 19th year that they would do what? They would call it as a current, right? Bring it up to current. And next year it's going to be paid off. Okay, now we come over and we take a look and we reclass it, and I showed you the journal entry. Now, we could also have obligations for a callable bond by the creditor. What happens here? A callable liability doesn't have to be a bond by the creditor. So what happens here? In fact, callable bonds are usually callable by the issuer. So we're talking about the creditor here. Okay, so what happens? What they'll do in these bond covenants, okay, in the bond contract and the covenants, they want to protect themselves. The investors want to protect themselves. So they'll put something in there like if the debt to equity ratio falls below a certain level, that they can call the debt immediately. Why are they saying? Maybe when they issue the bond, the debt to equity ratio was 2-to-1, right? But they say, hey, if it gets to a 1-to-1, now we're getting too close to the point where if it goes less than 1, we're potentially not going to get our money back, right? So they want to get out in front of the curve, and they'll say, as soon as the debt to equity ratio gets to 1.5-to-1, we have the option to call that debt immediately so that they're what? Getting their money before the situation goes worse, right? Okay? So if we have these sort of call features in our debt, we're going to have to go ahead and take a look at these rules and understand when we would have to show these as current liabilities, even though the term may be past that 1-year rule of thumb mark that we're using. Okay, so it could be a 5-year bond still. It could still be in that, year 2 or something. I keep saying bond, but it could be a note. Could be in year 2 of that note. It's still got more than a year to go before it matures, but one of these tripwires is what they typically call these have occurred, and so we're going to have to face the potential that it'll be called. Okay, so debt that is callable by the creditor in the upcoming year, even if the debt is not expected to be called, will have to be treated as a current liability. And the point here is these are current liabilities. Okay. Debt, when the debtor has the right to demand payment because of an existing violation of a provision of the debt agreement, makes it callable, then we have to put it into the current liability category. So here, just the fact that they have the option to call it, cause it to be a current liability, right? For this second bullet, what's happened? That debt to equity ratio, and I'm just using that as an example, has tripped, hasn't it? And even if they haven't called the debt yet, because they can call the debt at that point, we would have to put that as a current liability, because there's a chance that they could call it, right? Okay. Then what? The debt is not callable, but will be callable within the year if an existing violation is not corrected within a specific grace period. So sometimes they may give us a little grace period, but if it's still going to go past that grace period in that next year, it has to be considered current. Okay.
So it's possible that a 20-year bond will be considered during 20 years as a current liability because it's callable?
Because it is callable, if they can call it, even though it's 20 years, but they can call it at any time, meaning we have to pay it, then yes, it would be current. Or these last two bullets are really getting into, because and debt to equity is a common measure that's used to determine when a debt could be callable. Yeah. So it's either hit some sort of tripwire, and if it wasn't so hard to change the colors in PowerPoint, I would have made those blue, right? Or some other color, because these two here are sort of different than the first one, aren't they? Where these two, something's had to have happened. Isn't that beautiful? Okay, whereas in the first one, it's just callable just because it is callable. That's been allowed now. Okay? Okay, good. Come over. Any question on that? Okay, that's just rules. I mean, we don't have specific examples here of what's going on. Oops. Okay, so let's just go ahead and let's take a look at refinancing. what happens here now. Well, let's say we have a note. I'm going to go back to my 5-year note. We're now coming up on year 5. It's the end of year 4. But we're going to refinance that. Refinance that means we're going to do what? We're going to borrow money from maybe somebody else or even the same entity, and then do what? Take the money that we're borrowing and use it to pay down the amount that's currently coming due, right? Okay. Now, obviously, if we do that during year 4, that's a non-current liability now, isn't it? Never got to the point where we had to reclassify it as current. But what happens if the company hasn't done that yet? Will we give them time to show us evidence that they will do it before we issue the financial statements that will cause that what should have been a current to still be considered non-current? And the answer is yes. If the company intends to refinance it, even if they haven't refinanced it by the balance sheet date, but will before we issue the financial statements. Let's make sure we're clear on this. Even though December 31st is our year end, do we issue the statements on January 1st? We get them out that quick? No, there's what? A process that we have to go through to close. We have to have the process that many of you will be involved in, which is to come and audit that, etc. There's a certain requirements that we have reviews by our auditors, etc. before the financial statements are finally released by the client, right? Or when I'm saying client is from an auditor standpoint, but before the company actually releases it, there's usually a 2-3 month lag between and it depends on the size of the company, if it's a public company, between year end and when we actually issue the statements, okay? And what they're saying to us here is even if they haven't refinanced the debt at year end, okay, if they are able to refinance it before we issue the statements, they will literally let us do what? Let us classify that as non-current, even though at year end we hadn't actually refinanced it yet. Now, somebody asked about IFRS earlier, and this is an area where there is a significant difference between IFRS and US GAAP. IFRS will tell us, nope, you have to actually refinance it by December 31st, or we're not going to let you classify it as non-current. Okay? Okay, so we take a look, and we say that it has to be demonstrated by an existing refinancing agreement, or actual refinancing has to have happened prior to the financial statements in order to carry what you think should be non-current, what you think should be current, still keep it as non-current. Okay? So we come down, and let's take a look at this example. Brahms Company Ice Cream had 12 million notes that mature in 2019, and also had 4 million bonds issued in 1989 that mature in February. So both of these are going to mature the next year, aren't they? Okay, so we're thinking, maturing next year at the end of the year, December 31st, 2018, they better be what? Better be current, right? Now they come down and they tell us on December 31st, 2018, the company's fiscal year end, management intended to refinance both long-term notes. So at the end of the year, they had intended to refinance them. And in February 7th, they issued $4 million of 20-year bonds, applying the proceeds to repay the bond issue that matured that month. So that's that money from February. They got some $4 million in February, and they refinanced this $4 million here, didn't they? Okay, so if you take a look, notice they're taking the $12,000 that was considered our current, and since they've refinanced so far 4 of it, there's that 4 right there on the bonds payable. Well, I guess they're just showing the bonds payable down here as non-current, right? Okay, so they're just showing that as non-current. Because you would have had to have known the 12 to get the 5 is why they're showing that way. So all this is the $4 million, there it is, it's non-current because they refinanced it in February, right? That's that $4 million right here. In those 4,000, some zeros. Okay, then what? Brahms negotiated a line of credit with a commercial bank up to $7 million any time, and any borrowings will mature in 2 years from the date of the borrowing. And so since they have a line of credit that's available for them to refinance that, they go ahead and they remove that one from the current and keep it down in the non-current because they have that line of credit that's available, right? So they either actually refinance it or there's a refinancing agreement in place for them, either of those trigger the taking that out of the current and putting it into the non-current. Okay.
Where did the 5 million come from?
Well, they told us 12 million was the part that was maturing,
Okay.
and since they have 7, that still leaves 5 that would be considered current. And you're like, well, who cares, right? Well, on a question, I guess I might ask you, what's the current after all that? And you'd have to realize that you had to take the 12 minus the 7. Okay. Now, as I stated, U.S. GAAP lets us, keep it, I shouldn't say reclassify, keep it as non-current under those requirements that we said. We've either refinanced by the date of issue or we have a non-cancelable refinancing agreement in place. IFRS says what? You have to actually refinance it before the balance sheet date. So in both of those cases, we would not have been able to take the IFRS would have shown the whole 12 million still as what? Plus the 4 million on the bonds is all current, right? Okay. Okay, good. Come over and let's take a look at this one. Kim's Academia had 10 million of X bonds. Academy, not Academia. Academy had 10 million of X bonds payable due in 2019. Prior to 12/31/2018, Kim's refinanced 3 million of X bonds with other bonds that mature in 2029. On January 15, 2019, Kim refinanced another 2 million of X bonds with others that mature in 2026. Kim issued the financial statements on February 1st, 2019. On the February 15, 2019, Kim refinanced another 4 million of the bonds, and I don't have any idea where we are now. Let's see if they give us any feedback here, which is what? The 3 million refinanced 2-year end plus 2 million refinanced prior to the issue of the financial statement. Okay, they're asking what should be non-current. It's the amounts that she refinanced, right?
What if the company had issued a letter of intent of refinancing the other 4 million after before issuing the statement?
If it's before issuing the statements, and when you say a letter of intent to refinance, they have to have either refinanced it or they have to have an agreement in place for borrowing that'll allow them to refinance it. It can't just be, we intend to. There's got to be a contract that they can borrow the money to refinance. But yes, if that, they had either, well, obviously they couldn't have actually refinanced it at that point. If they actually refinanced it prior or they had the non-cancelable refinancing agreement, that would then be non-current as well. Okay, so we're looking for either the actual refinancing prior to the financial statements or something that indicates that they have the ability to refinance it, right? Okay, good. Loss contingencies. What happens here? Okay. What GAAP requires is that we look into the future and see if we are going to suffer losses. And if those losses meet certain conditions, we will literally have to book that loss immediately, right? Rule of conservatism says you have to book a loss immediately. Okay, now what happens? If it is probable that the loss will occur, we will have to make a journal entry for that. Okay, we will literally see that it means the event is likely to occur, and if we can estimate the amount of that loss, we will have to book that loss. If it's reasonably possible that we're going to have the loss, then we will have to make a footnote disclosure of either the amount that we think the loss is going to be or the range of potential losses. If it's remote, that means there's a what? The chance that it's remote the event will occur means it's not very likely. We don't have to do anything. We don't have to disclose. We don't have to book the loss. Okay? So you come over and you take a look, and this is a very useful little layout for us in that what? If a loss is probable, okay, and we know pretty much what the amount is going to be, we've got evidence to support what we think the amount's going to be, then we will go ahead and we will literally debit loss and credit liability. Even though the loss is not going to occur until what? Next year or whatever it is, we set up a liability for that immediately. Rule of conservatism. Okay? Now, if we're in a situation where it is reasonably, it is known and is reasonably estimable. Now, what happens if it is not reasonably estimable? We can't come up with an amount that we think is a reliable amount as to what it is that we're going to lose on this. Well, GAAP doesn't want us to go and just start putting nonsense numbers into the financial statements, right? So they will ask us to what? They will ask us to disclose, put a footnote disclosure as what that loss is going to be, okay? So it sounds sort of silly, okay, but the way I like to remember these is if it's reasonable and estimable. Reasonable and estimable, whatever, right? I'm saying it stupid like that on purpose so that you'll remember that. Reasonable and estimable, then you're going to do what? You're going to book it, aren't you? Okay? If it's what? If it's not reasonable but estimable, you're going to do what? Disclose. Okay? Now, we could have a loss that is probable, and that requires footnote disclosure. That's easy, right? And if we're in a situation where what? It's remote, you don't disclose anything. So this is actually a pretty easy rule, isn't it? Okay? If it's remote, you have to disclose. If it's, you don't have to do anything. If it's reasonably possible, you disclose. If it's what? If it's reasonable and estimable, you need to do what? You need to accrue and disclose, right? And then if it's not reasonable, you have to, not estimable, I should say, you have to do what? You have to disclose. All right? Okay, good. Then you come over. Yes, sir. You know, they use a reasonable person standard, okay? So it's not like they say you have to do X, Y, and Z, and that's how you know if it's, if you ask me if it's reasonable. They're going to rule. It is somewhat, did you say subjective? Yeah, it's somewhat subjective. I mean, they use a reasonable person standard, which, you know, you can go back to Supreme Court definitions and everything else, okay? So, you would have to have some sort of process for determining the likelihood. You have to convince your auditors of such, okay? Again, I don't need to keep trying to teach the auditing class, but if you were auditing a client and you knew they had this, say, outstanding litigation, you would literally ask, and there has to be direct communication between the CPA and the client's attorney, their external attorney or their in-house counsel, whatever they have. They will sit there and provide a letter directly to the CPA in which they will discuss any lawsuits, et cetera, that they consider to be likely, that they'll be probable that there'll be an unlikely, unfavorable outcome. Probably there'll be an unfavorable outcome, and they'll literally estimate the amounts, et cetera, in there, and that's one of the major pieces of evidence that the auditor would use to determine that they've gone through the due diligence to determine that it's probable. Okay. So I don't have a direct answer. It's not an algorithm. It's a subjective process. Okay, we do seek direct communication with the counsel for that client. Okay, all right, good. Now we come over, and when loss contingency is resolved, and in this case they're paying with a non-cash asset, which why I don't know, whatever. I mean, usually these lawsuits and stuff get settled in cash, but whatever, we had to give them. Notice we will go ahead and debit the loss and credit the asset account. Oh, I see. If it's going to be, I see. They're saying that if it's going to be settled with a non-cash asset, then you know that you're going to have to give up. Maybe you lost a suit on a patent, right? They're saying that you'd leave the patent on the financial statements, but what? Show a valuation allowance against the patent because you're going to have to turn that patent over to them, whatever. I don't know. Okay. All right. Come over and let's take a look at product warranties. Okay. Now, This works a lot like bad debt expense. Okay, when you have your bad debt expense and you have to take an allowance for that, you do what? You look at your sales, you take a percentage of your sales that you think are going to be uncollectible, you debit bad debt expense, and you credit the allowance, right? The what? The expense is the expense, and the allowance is a contra against your accounts receivable, right? Okay. Well, when we talk about warranty amounts, that is a similar process where we'll take an expense based on sales. So the company says we had $1 million of sales, we have warranty on this product, and we think that 2% of these warranties will be redeemed. So what will we do? We'll take an expense based on sales. What I say, $1 million of sales times 2%. So we take what, $2,000, whatever it is, $20,000 of our expense, and we'll credit what? We'll credit, and instead of crediting an allowance, we credit a liability for this future warranty amounts that'll come in. Okay, so it is very, very similar to the allowance process. Now you come over, and they give us an example here of these product warranties, and we have these sales of what, $2 million worth of chairs, and we indicate warranty costs of 3% of sales during the first 12 months and 4% for the next 12 months. So we go ahead and we take the sales revenue, and then we're literally going to go ahead and take the warranty expense for the 7% of that, the amounts that will come in the first year, the amounts that will come in the second year. Okay, so we're taking the expense what, in the year of sale, aren't we? It's 2018 sales, right? And we're taking that expense and that liability in what year? 2018, based on the sales number, right? Hello? What year did we make the sale? 2018. What year did we take the expense? 2018, right? You're saying, but wait a minute, they said that some of that wasn't going to come into the next year, the year after that. It does not matter. We want to match it what? Against the sale. Isn't that what we're doing here? Okay, just like you take the bad debt expense against the sale. Now we go ahead, and of course, so later on, if, you know, we have to pay $61,000 worth of, warranty costs for parts and labor or whatever it is we have to pay to fix this stuff, we would then debit the liability and credit the cash. The expense got taken when? In the period of sale, didn't it? So there was a match with the sale and the expense. Right? What was the event that triggered this separation of the assets? What caused this separation of our assets? Crediting, inventory, cash, whatever. What caused that to happen? Is it something we did in 2018 or something we did in 2019? No, it was something we did in 2018. We sold the stupid thing. Okay, we've got, and I think an example is even chairs, right? We've got chairs, don't we? And one day when we built one of these chairs, we built it with too short a leg, right? So then what happens? That was in 2018 when we sold it. In fact, here's a chair right here with two chairs. So that was what? In 2018, wasn't it? When we sold the stupid chair? And it's not until 2019 that we find out, yep, this was the chair, and we fix it now, right? So even though we're, sacrificing the asset now, the event that triggered that was the sale of that chair back in 2018, right? Which is where the expense is. If we didn't take the expense until somebody came in to claim the warranty, this is how our financial statements would look. In 2018, we would take revenue. Revenue would be what? $2 million? And the expense would be 0. right? Because we didn't take any warranty expense, right? And then we would go ahead and we'd have net income of 2 million. Now let's say that in 2019, we have to pay money to fix a bunch of broken chairs. And we pay 70,000, let's say, right, to fix those, okay? And let's say we had no revenue, so revenue would be 0 in 2019. Expenses would be 70,000. So we would show what? We would show net income, and this would be a net loss, of $70,000 in 2019, wouldn't we? But wait a minute. Why did you end up with that 70,000 if you had to pop up in 2019? It was because you sold this stupid stuff in 2018, right? And offered a warranty, of course, that you would fix it if it was broken, right? So we take warranties and we match them with the year of sale. The impact on the income statement happens what? In 2018. The impact on the balance sheet, all it is a reclass out of liability and out of assets, right? To keep my accounting equation in balance, assets equal liability plus stockholders' equity. My liability comes down, my assets come down into pure balance sheet debt. Just like when you have the write-off of your accounts receivable, when after somebody comes back after the year of sale, right? We can have the same discussion for the allowance. That's why I said it's very similar. If somebody comes back after the year of sale and says, I can't pay you, we simply debit the allowance and credit the accounts receivable in that period because what? The expense already got matched with the sale, right? Back in the earlier year.
So what happens if we overestimate the warranty expense?
We will have...
For example, if we had 70,000 of warranty expense and then only 60,000 of actual expense.
You took a liability of 70,000, but there was only 60,000 of actual warranty expense. Then what we would do is we would go forward, change an accounting estimate, and if we put too much in now, then that would mean that my actual estimate of the amount of warranties that get claimed would come down, wouldn't it? Right, I was putting in 2%, but maybe it's closer to 1% based on the fact that you're saying it was less. So next year I'll take what? I'll only take 1%, and we drive down the highway trying to keep the car as much as in the lanes as we can.
But on the income statement.
Income statement, we won't show income statement what? All that's happened at this point, you're saying if we estimated 70,000, we took 60, expenses showing 60,000. I mean, expenses isn't showing, isn't going to show anything at this point. We're just going to have to deal with the cash. I was showing you what happened here if we didn't take the expense until, here we didn't take anything until the person came in, right? Okay, but if you're telling me that in that next year we made the amount and that next year it comes in at a different amount, we'll sit here and we'll debit the liability for 60, right? And credit the cash, whatever. And under your scenario now, there'll be 10,000 sitting in that liability account, won't there? Okay, but we're going to still sell stuff in that next year, aren't we? So we'll continue to sell stuff in that next year, but now we don't need quite that whole 2%. We don't need quite as much, and the reason we don't need quite as much is because our product is actually a little more reliable than we thought. And like I said, we try to go down that road trying to keep it as much in between the lanes as we can. Of course, in a car, you definitely keep them in the lanes. I mean, the only thing, have you ever thought about how we drive on highways at 60, 70 miles an hour, and all it is these little white lines in between us when we look at the guy next to us, meanwhile we're in this perilous situation? Why? Because the guy next to you has as much to lose as you do. That's the only thing that's keeping it in those lanes. Anyway, so what happens? Completely different discussion. But what happens? We're trying our best to do what? To keep it in the, in as close as we can.
And would it be more profitable to take as much warranty expense as possible in order to increase tax?
Tax purposes, I don't think they let you write off the estimate. The tax, you could only take an amount for what you actually paid. I don't think tax purposes, they allow you to take a warranty estimate for
So
liability.
the net income wouldn't change in
we're going to study deferred taxes in another chapter, but there will always be a difference between our book income and our tax income. And they require us to report a deferred tax liability for differences between those two. Yeah, because there's difference in the tax rules versus the GAAP rules. So something that we take an expense for GAAP purposes, we don't take an expense for tax purposes. So we'll have a different net income versus taxable income. And we literally have to put a liability down for those differences, because eventually those differences we think will reverse at some point, and we put down a deferred tax, for that. Whole nother subject. Okay. I wanted to say something else on this subject. The allowance, I think what I want to say is the allowance works the same way, doesn't it? I mean, we take the expense now, and then what? Then we go forward, and we keep trying to hit the right number. Oh, I know what I thought you were going to ask me. I thought what you were going to ask me is, well, what happens if we're having a particularly good year? It would be smart to take a bigger liability for warranties now, so that our net income stays right at about a number that we like it, where we like it, and then later, if things don't go too bad and all these people don't come in and claim the warranties, then we can take a little less warranty expense and we can keep a nice even straight line for our profits, right? Well, that would be called managing profits, and that's a no-no. Can't do that. You can't sit there. You would have to have a reasonable basis for how you came up with these, actual tracking of records of what actually got returned, engineer estimates of what will be returned. So it's not like you can just sit here and say, well, what will our net income be if we put this much liability expense? Well, what would it be if we put this much liability expense? No, it has to be based on analysis, right? Now, the reason I'm saying this in the context of, I mentioned account receivable, I was on an assignment where we were looking at banks' loan receivable, and Congress wanted us to look at to what extent banks were doing a good job for putting amounts in the allowance for that. And when we looked, they had fairly sophisticated processes, and we looked at big commercial banks. We were looking at a couple here in the Bay Area that I was leading the work on that, but we had banks across the country that other people were working on. I was looking at 2 big banks in the Bay Area. Can you think what those might be? Okay, that time it was B of A and Wells Fargo, I'll just tell you. Okay, it was B of A and Wells Fargo, and what they were doing at that time is they were taking an additional unallocated portion to their allowance for loan loss. So they would go through and they would take amounts based on homogeneous loans, credit card loans, and they had migration analysis they did for that. Individual loans, they would do an analysis of the commercial real estate property associated with that. And part of the reason Congress was concerned, because everyone was predicting this big drop in commercial real estate that was going to happen in the next couple of years. The big A-bomb didn't hit then, it hit like 10 years later, but whatever. So we're sitting here and we look at all that process, but then the banks would kick in an additional unallocated, and they had no support for that. The auditors never called them on it, because as far as auditors concerned, if you report a lower net income, that actually lowers their audit risk. The regulators didn't call them on it, because if they reported lower loan balances, then they would have to set aside more in their reserves for that. So for a safety and soundness standpoint, the regulators never called them on it. My office, the GAO, we called them on it because we were looking at the issue of your managing profits. If you take amounts and you just throw them into bad debt expense and allowance now, then later on you can sit there and not put as much in. There's no rationale as to exactly how you're putting that additional and allocated. Eventually you just pull it out. They were essentially managing the profits. And so you can't just throw amounts in for these estimates willy-nilly. You have to have a sophisticated process, and you try to keep it as much on target as you can. Okay, and that's why God invented computers. Okay, because computers will allow you to track data back years and years. You'll have a huge database for this. Okay. All right. Any question on that? Okay, guys, I'll tell you what. Let's go ahead and let's cut it off right now, because we're about 10 minutes till, and I think if I start getting into some of the other ones, we get out at 1 o'clock, right? Yeah. 1, you won't hear me, and 2, you'll forget it anyway. But before we go, I do want to make sure I know who's here. So bear with me for that, and then we'll get out.